Welcome back to the Daily Crypto Roundup. Today, we've got a big one because Bitcoin is still trying to find its footing after another rough stretch, but the market is not completely dead. We've got Bitcoin reacting to softer inflation data, Federal Reserve rate pressure still hanging over risk assets, BlackRock updating its Bitcoin income ETF filing, Michael Saylor getting into a public back and forth over Strategy's latest share sale, the CFTC moving toward its first proper U.S. rule proposal for prediction markets, and another reminder that hype-driven crypto deals can collapse very quickly when the market turns. Before we get into the coin prices and the main stories, today's episode is brought to you by Kraken. If you're buying, selling, or building your long-term crypto position, Kraken is one of the most trusted names in the market, with access to Bitcoin, Ethereum, Solana, XRP, Dogecoin, Cardano, and more. And here's the bonus for listeners. If you sign up to Kraken using our link in the description, we are giving away 20 XRP to anyone who uses the link. So if you've been thinking about setting up an account, this is a good time to do it. The link is in the description. Also, we're going to be getting properly active again on X, so give us a follow over there as well. The link is in the description. We'll be posting market updates, quick reactions, coin price moves, and clips from the show. Now let's get into the market. The first big story today is Bitcoin and inflation. Bitcoin dipped towards $61,000 earlier as traders braced for the latest US inflation data. The reason this matters is simple. Crypto is still very sensitive to interest rate expectations. If inflation stays hot, the Federal Reserve has less room to cut rates. And in this market, there is now even talk of rate hikes being priced in later in the year. That is not what crypto wants to hear. Bitcoin, tech stocks, growth stocks, and speculative assets all tend to struggle when yields rise and money gets tighter. When investors can get a better return from safer assets, they become less willing to chase risk. And that is exactly why inflation data has become one of the most important drivers for Bitcoin right now. The slightly better news is that core inflation came in softer than expected. Headline CPI rose 0.5% for the month, in line with forecasts, and the annual figure was 4.2%. But core CPI, which strips out food and energy, rose 0.2% instead of the expected 0.3%. That helped Bitcoin bounce back above $62,000 for a while, and it also helped some crypto-related stocks. Strategy moved higher, Coinbase gained, Robinhood jumped, and several Bitcoin mining names also improved. But we need to be honest. This is not a full recovery yet. Bitcoin bouncing from $61,000 to $62,000 is not the same as the bull market being back. The market still needs to see whether Bitcoin can hold these levels, whether ETF flows stabilize, and whether the Federal Reserve pressure starts to fade. Right now, the key level remains $60,000. If Bitcoin keeps holding above that, bulls can argue the market is wounded but not broken. But if Bitcoin loses $60,000 cleanly, the next major conversation becomes whether $53,000 is on the table. And that is why this moment feels so tense. Because Bitcoin is not just fighting price resistance, it is fighting macro pressure, interest rate worries, weaker liquidity, and competition from other major market stories. One of those stories is artificial intelligence. Crypto traders are watching the AI boom closely because capital is clearly moving into data centers, chips, and infrastructure. Bitcoin miners themselves are even shifting more resources toward AI and high-performance computing. Hut 8 has raised billions to build AI data center infrastructure in Texas, while other mining-related companies are using debt and Bitcoin sales to fund their AI expansion. That tells you something important. Even companies that came from the Bitcoin mining world are now chasing the AI infrastructure trade. That does not mean Bitcoin is finished, but it does show where Wall Street's attention is right now. The big money is not just asking, what is Bitcoin doing? It is asking, where is the next major growth opportunity? And right now, AI is competing aggressively for that capital. The second big story is BlackRock's new Bitcoin income ETF filing. BlackRock has updated the filing for its proposed Bitcoin Premium Income ETF, expected to trade under the ticker BITA. This fund is not just another basic Bitcoin ETF. It is designed to generate income by selling covered call options linked to IBIT, BlackRock's Spot Bitcoin ETF, and other Bitcoin ETF-related indexes. In simple terms, covered calls are a way of generating income from an asset, but they usually come with a trade-off. Investors may receive yield, but if Bitcoin suddenly rips higher, the fund may not capture all of the upside. That is important because it shows how Wall Street is changing the Bitcoin product market. At first, the big story was simple spot Bitcoin exposure. Then came ETFs. Now we're seeing income products, option strategies, and more complex structures built around Bitcoin. BlackRock has disclosed a 0.65% sponsor fee and around $9.99 million in net assets in the updated filing. The reason this matters is because it shows institutional crypto is still developing, even while the market is weak. Retail traders may be panicking about price, but BlackRock is still building products. Goldman Sachs has also been looking at Bitcoin premium-style ETF structures. So the long-term Wall Street build-out has not stopped. The issue is that these products do not automatically mean price goes up tomorrow. They are infrastructure. They broaden the market. They give investors more ways to access Bitcoin. But in the short term, Bitcoin still needs demand, confidence, and liquidity. The third big story is Michael Saylor and Strategy. Strategy's latest Bitcoin purchase has sparked a public debate over whether the company's recent share sale was accretive or dilutive for shareholders. The argument centers on Strategy's BTC yield metric, which fell from 13.0% to 12.8% after the company acquired another 1,550 Bitcoin. Critics argued that this meant the transaction was dilutive on a Bitcoin per share basis. In other words, even though Strategy bought more Bitcoin overall, shareholders may have ended up with slightly less Bitcoin exposure per assumed diluted share. Michael Saylor pushed back by saying BTC yield is a narrow metric and does not include the company's cash reserves. His argument is that the transaction also added around $100 million in US dollar reserves, lifting Strategy's total dollar reserve to around $1 billion. So from his point of view, the transaction improved the overall balance sheet when both Bitcoin and cash are counted. This is a really important debate because Strategy is no longer just a company that owns Bitcoin. It has become one of the biggest symbols of the entire Bitcoin treasury trade. When Bitcoin is rising, the model looks genius. Raise capital, buy more Bitcoin, increase exposure, and let the market reward the strategy. But when Bitcoin is falling, people start asking harder questions. Is the structure still working? Are shareholders being diluted? Is the company creating value or just using financial engineering to keep the Bitcoin machine going? My take is this. Saylor still matters massively for Bitcoin sentiment, but investors are now watching the details far more closely. The market is no longer blindly cheering every Bitcoin purchase. It wants to know whether those purchases actually improve shareholder value. And that is a healthy shift. It means the market is maturing, but it also means Strategy has less room for vague messaging than it used to. The fourth story is prediction markets. The CFTC has proposed its first U.S. rule framework for prediction markets. This matters because platforms like Kalshi, Polymarket, and Crypto.com have pushed event-based markets into the mainstream, especially around politics, sports, and major world events. The proposal would give the CFTC a clearer process for deciding whether certain contracts are in the public interest. There would be a review system, and the agency would look at whether contracts involve areas such as war, terrorism, assassination, illegal activity, or gaming. But what is interesting is that the CFTC does not seem to be trying to kill the industry. The tone is more about creating rules so legitimate prediction markets can continue. That is a big deal for crypto because prediction markets are one of the few areas where blockchain-based products have shown real public interest beyond just trading coins. People understand betting on outcomes. They understand elections, sports, economic events, and yes or no markets. If prediction markets get clearer regulation in the United States, that could be a major step toward mainstream adoption. The final story is another warning about hype. There has been renewed attention on a Trump family-linked crypto deal collapse and the wider lesson it gives investors. The key point is not to blindly chase celebrity names, political names, meme narratives, or pre-sale promises. A sponsored article has been promoting tokens like Bitcoin Cash, Litecoin as alternatives, but the real lesson here is bigger than any single token. The lesson is risk management. When markets are weak, hype projects become extremely dangerous. Anything promising huge returns, massive pre-sale gains, or guaranteed upside needs to be treated with caution. Crypto can create life-changing gains, but it can also wipe people out when they confuse marketing with fundamentals. That is why, in this market, the focus needs to be on liquidity, security, real usage, and position sizing. Bitcoin is still the market leader. Ethereum still has the strongest smart contract ecosystem. Solana still has speed and developer activity. XRP still has a payments and institutional settlement narrative. But even with the strongest names, you still need discipline. So where does that leave the market today? Bitcoin is trying to stabilize, but it has not proven strength yet. Softer core inflation helped, but rate pressure is still there. BlackRock is still building Bitcoin products, but that does not mean price goes straight up. Saylor is still buying, but strategy is now facing tougher scrutiny. Prediction markets are getting closer to real regulatory structure, which could be bullish for the sector. And hype-driven crypto remains dangerous, especially in a weak market. The level to watch is still $60,000. If Bitcoin holds it, the market has a chance to rebuild. If it loses it, the fear around $53,000 will get louder. For now, this is not a clean bull market. It is a testing phase. And in a testing phase, patience matters more than hype. Keep your risk under control, avoid emotional entries, and remember that the strongest opportunities usually come when the market feels uncomfortable, not when everyone is already celebrating. That's it for today's Daily Crypto Roundup. If you found this useful, like and follow, check out the Kraken link in the description for your chance to win 20 XRP. And make sure you follow us on X as we start posting there again properly. As always, we'll see you at the top.